it's Robert Thompson again, and we're here talking about the third C of the four C's of what a bank looks for when they're making a real estate loan to you. And these are the things that they look for to make sure that they're going to be protected in the case of something going wrong, that they're not going to lose money, they're going to hopefully get their money back out of it. Now, the third C here is capacity, and what capacity means is your capacity to pay back the loan that they've made to you. So they're going to do things like check your employment, they're going to verify your employment somehow, or if you're self-employed, they're going to do some other things just to make sure that you are actually gainfully earning money so that you can pay off your obligations. Now, the second thing they're going to do, and this goes back to the credit report we talked about, the credit video that we talked about this already somewhat, but they're going to go through your credit report and pull out line items of current debts and find out what your monthly payment is on all of those. And then they're also going to get your proposed housing payment, which, let's just say you've got principal, interest, taxes, insurance, and homeowners association fees of $2,000. And let's say your monthly debt on the credit report is $500 a month. So you've got $2,500 a month in debt as far as the bank's concerned. Now, what they're going to do is they're going to take that debt, and it's a debt to income ratio, so they need your income now to get the rest of the ratio. So they're going to look at your gross monthly income, meaning your income before taxes and all that good stuff. So if you make $5,000, but you only have checks of $4,000, they're still going to count the $5,000. But let's just say it is $5,000. Let's say our debt was the $2,500, and so we've got $2,500 divided by $5,000. That's a 50% debt to income ratio. Now, some loans will allow that. Some loans will not allow a 50% debt to income ratio. And this is all also dependent on your credit and that kind of thing, how good your score is and that kind of stuff. But they're going to say, okay, well, you're within the loan guidelines. I mean, we allow a 50% debt to income ratio. You've got the credit that we need. So your capacity to repay in our eyes is adequate, and we will make the loan to you. And that's what capacity is all about. It's just your ability to repay and the verification process the bank goes through to make sure that they're on the same page and agree that that is, in fact, the case. Thanks. Bye.